Good day. Welcome to another session of Fog Accountancy Tutorials. We continue our series on partnership by looking at the admission of a new partner. We are going to look at the accounting procedures that are involved when a partner is being admitted into the partnership firm. Now, take note that over here, our emphasis will be on not only the admission, but on the valuation of goodwill and how to treat goodwill. So this very video is committed to helping us understand what we do when we are admitting a partner amidst the valuation of goodwill. And so that is what we are going to do. So in our next video, we will still talk about admission of a partner, but that video will emphasize on revaluation of assets and liabilities in general. So on this very day, or in this very video, we are focusing on goodwill valuations. And so we are going to learn how to value goodwill in admission of a partner. That is very important. Now, take note that when a new partner is being admitted, it's a very simple issue. What is happening is that the person that is coming is bringing capital. The capital can be in the form of cash or any other assets. Now, when the partner is being admitted, usually you'll be given a statement of financial position in the question, or even in practice, what we do is that we have to prepare a statement of financial position at the date of admission, or assets, or let me say, we have to prepare a statement of financial position just before the admission. And when we admit the partner, we have to, after the procedures, we prepare a new statement of financial position after the admission. Now, in your case as a student, what you'll be given is that you would usually be given the statement of financial position just before the admission, and then they will give you the terms and conditions of the admission. Your job is that you now factor the terms and conditions of the admission, the capital that is being contributed by the new partner, if there was any valuation of goodwill, will factor all that, and then you redraft a new statement of financial position, having taken into consideration all the terms and conditions of the admission. That is basically what we are going to do. And so we will look at a question straight away. But before we look at a question, I want you to understand what goodwill is all about. And so we are going to look at goodwill. What is goodwill? Now, goodwill is defined as an intangible asset. So goodwill is an intangible asset which represents all the factors that enable a business to operate successfully. I repeat that goodwill is an intangible asset which represents all the factors that enable a business to operate successfully. Now, goodwill could be valued freshly from the business operations, or it could be purchased as part of business acquisition. So we have valued goodwill by the business, and we have purchased goodwill. Now, what we are saying is that goodwill is very important because when a business operates over time, the business accumulates goodwill through a lot of means. We have so many ways of goodwill valuation. We have the super profit method, a whole lot of methods that we can use for goodwill valuation. My focus in this video is not about goodwill valuation because we are looking at partnership accounts where you will be given the goodwill already valued. So my focus now is that I'm giving you a question where goodwill is already valued. So we are not going to learn how to value goodwill. We are only going to learn how to treat the valued goodwill in our books. And so, like I explained, we have internally valued goodwill. And then we have the purchased goodwill. So, internally valued goodwill is when the business themselves look at their situation and then value the goodwill, that these are the factors that are enabling them to operate successfully, and it has a value. And so it's an intangible non-current asset. They value it themselves, or the purchase goodwill. The purchase goodwill is the excess of the purchase consideration of a business over its net identifiable assets. And so when you are going to buy a business, for example, let's say you want to buy let's say a partnership firm, you want to buy a firm, and the net assets of the firm is 200 million. 200 million Ghana cedis. Let's assume this is the net assets of the firm. You, the purchaser, will you be willing to pay exactly 200 million, or you think it will be fair to pay more than 200 million? Now, the assets are 200 million, but the seller could require that you pay 250 million, which you may gladly pay. Now, the reason why you will be ready to pay the extra 50 million is that the business may have been in existence for a long time, and there are a lot of factors that are enabling the business to operate successfully. And you, the new owner, is coming to enjoy those factors. For example, you already have a customer base which you will not need to fight so hard to get customers. Maybe they are located in a very good place for business. You have a good location as an advantage. Maybe you buying the business already has a good brand, an established brand name that is accepted, good reputation in society. And so all these things that you are coming to enjoy as a new owner, if you want to pay only 200 million, which equals to the net assets of the firm, to the firm owners and buy, that will be a cheat, because you have not paid for all those other factors that you are coming to enjoy. The other factors that you are going to enjoy is what we call goodwill. It will help you to operate successfully because someone has already labored for those factors and made them possible for you to operate. And you are now coming to enjoy something you have not labored for because it's an already established business. And so because you are going to enjoy the success of an already established business and brand name, you must pay something extra for that. And the extra you pay is what we call goodwill. That is why I told you that goodwill represents all the factors. It's an intangible asset that represents all the factors that enables a business to operate successfully. And so if you pay 250 million, the extra 50 million that you are paying, for is called goodwill. That is called purchased goodwill. So the 250 million is your purchase consideration, how much you are buying the business for, and the business net asset is 200 million. And so the business value in net asset is 200 million. You are paying 250 million, an extra 50 million for goodwill. That is the meaning of purchase goodwill. And so I'm sure this has enhanced your understanding of the concept of goodwill. Now, what we are also going to do with the admission of the partner is that when we are admitting a partner, for example, if two of us are in partnership and we want to admit a third partner, we may have been in the partnership for so many years, established a good brand, good reputation, customer base, and all that. Now, the new person that is coming to enjoy what we have labored for, which he did not labor for. And so we have to now value the goodwill internally, and then maybe ask the person to pay for the goodwill or share the value of the goodwill, and we will not allocate part to him because he did not labor for that goodwill. So that is what is going to necessitate the valuation of internally generated goodwill. And so if we have been in operation for a long time and you are coming to join us as a partner, obviously we need to know the goodwill we have accumulated over time so that we will now know how to go about it, whether to ask you to pay for the goodwill or maybe we will share the value of the goodwill without giving you some. Now, what I have done so far is that I have explained how to calculate the purchase goodwill, but I have not explained how to calculate the internally generated goodwill. That is why I told you there are so many methods of calculating, which I'm not going to go into that for now because that is not my focus. Maybe in another video I may just dedicate one video to try and teach how to calculate goodwill, but for now it is always assumed it has been calculated for you in the question, and my focus is to teach you the accounting treatment for the goodwill that you have. Okay. And so without too much further time wasting, I want us to pick a question which involves admission of a partner and a goodwill valuation. And then let's know how we are going to go about this procedure. Edu and Boatin have been in partnership for 10 years. sharing profit and losses equally. On 1st January 2019, they decided to admit Collins. The statement of financial position of Edu and Boateng before the admission of Collins is as follows. So they have non-current assets to be 75,000, and under current assets they have inventory to be 40,000, receivables 25,000, and cash to be 15,000, giving us a total asset of 155,000. And then they have under equity they have a capital accounts. Edu's capital account is 80,000 and Boateng's capital account is 60,000. And then that gives us a total capital of 140,000. And then they have current liabilities of creditors, which is 15,000, giving us total equities and liabilities of 155,000. Then we continue. The following information is also relevant. Collins, as part of his admission, will provide a capital in cash of 55,000 Ghana cedis to the partnership firm. Goodwill, which has never existed in the books, is to be valued at 50,000 Ghana cedis. The profit and loss sharing ratio after the admission of Collins is to be in a ratio of 4:4:2 for Edu, Boateng, and Collins respectively. You are required to show the following accounts. A, the Goodwill account. B, the partners' capital accounts. C, the statement of financial position after the admission of Collins. Note, solve the above question for two different scenarios where I, goodwill is to be maintained in the books. II, goodwill is not to be maintained in the books. Okay, and so that's the question. Now my focus is on the last part of the question. We have two scenarios. Now listen, I intentionally added those two so that we can do both scenarios, so that anyone that you meet in the exam, you would be able to do it. What I'm saying here is that now there could be two different ways that you would treat goodwill. Now when goodwill is valued on the admission of a partner, it's either the question will ask you to maintain or keep goodwill in the books, or goodwill should be written off from the books, not to be maintained. When we are asked to maintain goodwill in the books, it means that goodwill should appear on the statement of financial position that we will prepare as a non-current asset. That means goodwill is in the books. If goodwill is not to be maintained in the books, it means that goodwill should not appear in your statement of financial position. It shouldn't appear. In any of these two cases, we will still open the Goodwill account. But remember that before you maintain goodwill in your books, there should be a balance carried down on the Goodwill account, which will be a balance that will be taken to the non-current asset of the statement of financial position. But when goodwill is to be written off, there should not be any balance carried down on the Goodwill account. And so we will close the Goodwill account and nothing of goodwill will go into the statement of financial position. So those are the two scenarios. So we are going to prepare the Goodwill account, the partners' capital accounts, and the statement of financial position. However, we are going to do these three accounts for each of the two scenarios. And so I'm going to start with a scenario where goodwill is to be maintained in the books. So that is what we are going to do. And so I'm going to solve for the Goodwill account, for the partners' capital account, and for the statement of financial position, bearing in mind that I'm going to maintain goodwill in the books. And then after that, I'll wipe that off again, and I'll prepare again the Goodwill account, the partners' capital account, and then the statement of financial position, bearing in mind that I'm not going to maintain or I'm writing off goodwill in the book. So that's the meaning of the scenarios. So I'm going to prepare two different solutions with each scenario in mind. Okay, so we prepare the Goodwill account. That is the first account that we prepare in the books of Edu, Boateng, and Collins. And so I'll say Goodwill account. Let me put my currency signs where they are supposed to be. Okay, so I'll go into the Goodwill account and then we debit the Goodwill account because Goodwill has a debit balance. But then in debiting the Goodwill account, we are not just going to debit the whole amount of 50,000 on the debit just like that. We are supposed to debit whilst sharing for the old partners. Remember that I told you that the new partner that is coming did not work for this Goodwill. So he's not going to enjoy the Goodwill. And because we are maintaining Goodwill in the books, we'll just share by the old partners a profit and loss sharing ratio. Now, the question gave ratios. The old ratios was not mentioned. So Edu and Boateng were sharing profit and losses. But then the ratio was not given. And by default, if the ratios were not given, you share it equally. Because according to the rule, we are saying that where there is no partnership agreement, profit and losses should be shared equally. And so we'll come here, we assume that they are sharing it equally, and we'll say we are going to share and it's going to their capital account. So I'll say capitals, Edu, which is half of the amount, 50,000. That will be 25,000 for Edu, and then for Boateng will be half of the same 50,000, which is going to be 25,000. This is how the Goodwill account will appear. So what I have done basically is that I have debited the Goodwill account with 50,000, but it was done whilst we split the amount for the two partners. And then I'll just say a balance carried down at the end will be 50,000 on the Goodwill account. So we can close the Goodwill account. And then there will be a balance brought down of 50,000. So this is how the Goodwill account will appear. Remember that once you are preparing the Goodwill account, you share the amount on the debit side. And the narration will be capitals because the corresponding entry will go into the capital accounts for their partners. That is how they will share this Goodwill without the new partner benefiting. And so this is for the first scenario. And then after the Goodwill account, as simple as we've done, we'll now come and prepare the capital accounts. Okay, so we'll see capital accounts of the partners, and then the first column will be for Edu, Boateng, and Collins. Edu, Boateng, and Collins. Okay, we'll bring our currency sign in there. Okay, so this is an assumption that we are operating a fluctuating capital account, because remember that if it was a fixed capital account, then the goodwill and other things will be sent to the current account instead. And so we'll start with the balance brought forward for the partners account, the partners capital account. So their opening balances, which were the balances on the statement of financial position, are Edu's balance on capital is 80,000, and then that of Boateng is 60,000. And then from there, we would look at what has transpired so far. Remember that we just splitted the goodwill into two, which is their old profit and loss sharing ratio. And so 25,000 for Edu and 25,000 for Boateng. So that will be, the corresponding entry will be on the credit side of the capital account. And so we will now say goodwill. For Edu will be 25,000, and for Boatin to 25,000. And so that is that for the goodwill. And then we look at the new partner that is coming, Collins. Collins is bringing in capital of 55,000 in a form of cash. And so we'll come and say cash for Collins, 55,000. And that will be all for the capital accounts. There is nothing more in the question that is coming into the capital accounts. And so we'll just close off the capital accounts and then we'll balance it off. So as easy as ABC. And so therefore, when we balance, we're doing it according to each partner. And so Edu's total will be 105,000, and then 85,000 for Boatin, and then 55,000 for Collins. So that will be their balance carried down. 105,000, 85,000, and 55,000 respectively. Okay, so the balance brought down their capital account will be 105,000 for Edu, 85,000 for Boatin, and 55,000 for Collins. Okay, so this is how the capital accounts is going to look like. And then finally, we have to prepare the statement of financial position, a new statement of financial position to reflect the admission. And so let me see if I can prepare that here. We can appreciate the figures. And so I will say statement of financial position as at 1st January 2019 when we admitted Collins. So when they admitted Collins, we are preparing a statement of financial position to reflect the admission. And then we'll begin with our non-current assets. Now, with the non-current assets, we had, in the question, there was a non-current asset of 75,000 that we had in the question already. So that one is a non-current asset that we have as per the question. And then remember that we are told that goodwill is to be maintained in the books. So there is a goodwill of 50,000 that will also appear. And so our goodwill will appear as 50,000. And then there will be the sundry or total non-current assets as per the question, which also is 75,000. That one did not change. And so we have total non-current assets as 125,000. And then we will move to our current assets. And so the reason why we said goodwill is to be maintained in the books is that it should appear in your statement of financial position. In the second scenario, where goodwill will not be maintained in the books, we are not going to show this in the statement of financial position. We are going to write it off. So that is the difference. And so we'll move to our current assets. And then with our current assets, we had inventories in the question. The value of inventories was 40,000. Nothing really changed about that. And then we have receivables as well. The figure for receivables was 25,000, which also did not change. So we repeat that also. All that we need is that we're only reflecting figures that changed. And then there was cash in the original statement of financial position. Now, the value of cash in that statement of financial position was 15,000. Now, remember that the new partner, Collins, also brought in some cash of 55,000. So that is going to add up to the already existing cash. And so that will be the original 15,000 plus the new 55,000 that was brought in by Collins, giving us a total cash of 70,000. And when we add that up, we are going to have total current assets of 135,000. And so when we add 135,000 to the total non-current assets, we are having for total assets 260,000. So that is our total for the total assets. That's the total assets figure that we have. And then we go to the equity and liabilities, which is, so let me do that here as well. So we'll say equity and liabilities. We'll start with our capitals. Now, the capital accounts, there are 3 different partners now, unlike the original 2 that we had. And so we'll put each of them their capital balances. So for Edu, for Boateng, and for Collins. Edu's capital balance now is 105,000. For Boateng is 85,000. And then for Collins is 55,000. Okay, so we sum that up, and then we have a total capital of 245,000. And then remember, there were some current liabilities as well. There was a creditors, or let's say payables figure of 15,000. And so when we add the 15,000 to the capitals, we have 260,000, which is the total equity and liabilities. And so, ladies and gentlemen, it has balanced. The total assets equals to total equity and liabilities. So this is how the solution will be presented for the partners on the admission of a new partner where goodwill is to be maintained in the books. Now, we are going to also present the solution, the same solution. This time, we are going to bear the second scenario in mind, that goodwill is not to be maintained in the books. And so we will close off the goodwill account and it will not appear as it has. And then we will see how it will affect the accounts as well. And so this is how we go by a situation where goodwill is to be maintained in the books. So you can look at it again.